2024 has been an absolutely insane year for the evaluation industry. It started off with MetaQuotes cutting off prop firms, to other firms banning US traders, to traders being forced to migrate and learn completely new platforms. It has been completely crazy. And that's not even mentioning the closure or temporary closure of the Funded Trader, one of, if not the largest evaluation firm in the industry. But now there's a completely new change that is taking place. Now that some of the dust has settled, there's a new change that traders are going to need to adapt and figure out what it means for their trading. And that change is the tightening of rules, of making rules for all challenges across the board more difficult to pass, more difficult to get funded, and therefore more difficult to go on and receive a payout. Now, all of these rules we are going to break down, but I think this is what the future of the prop firm industry looks like, and in order to stay on top of it and get funded and receive those payouts that you're working hard towards, you need to understand what's going on and what's next. As usual, the usual disclaimer for this video is I don't want to speak bad on any specific firm. I am a huge firm believer in competition making everyone better. I want there to be competition. I want there to be a lot of firms in the industry, so I'm going to do my best not to name any specific names. You can easily find out the rules that we're talking about in this video online. I don't want to speak ill or misrepresent or misspeak on any individual single firm, so that is the usual caveat. Okay, rule number one that we are seeing the industry implement is a risk rule. More specifically, we're seeing some firms implement a 1% or max 2% risk rule per trade. Now that is either a max risk rule per trade idea, or open risk overall. Some firms are stricter than others. Some are looser and saying that you can risk 2% per trade idea, depending on how they actually measure that trade idea. But overall, we are seeing firms implement a risk rule, a restriction on how much you can actually risk on your account. Now this goes beyond the usual maximum and daily drawdown limits, which makes this interesting. And it certainly does restrict traders, but personally it's nice to see because it means that firms are now looking for traders that are risk managed and not just traders that are going to gamble, therefore gamblers on their platform. You see, for firms, the biggest risk that they can have on their books is a trader that just signs up for 20 challenges, full margins all of them, and passes one, and then full margins that account and goes on to receive a massive payout. The reason this is a huge risk is because that trader's data is 100% useless. There's a major difference between a trader that is going full margin versus a trader that is risking 0.5% and is being very consistent and is taking their time and is actually trading the market over a long period of time and not just hoping to capitalize on one or two quick movements in the market. Now, this is a difficult situation for firms because if they are short-term thinkers, well, you're going to love these traders in the short term. If they have to sign up for 20 challenges in order to pass one, you're going to be getting all of that revenue from those failed challenges, which looks great for a firm, but long term it is not sustainable whatsoever because you're going to allow those types of traders that have that trading activity that simply is not going to be beneficial long term. It is just gambling. And so it's nice to see, for the Lark perspective, it's nice to see this rule being implemented because it really shows that firms are thinking long term. Now at Lark Funding, we don't have a risk rule like this. We don't have a max open risk rule. We do have some lot size restrictions we've had since we launched in 2022, but no rule like this as of yet. I think it would be nice to potentially objectify further our all or nothing prohibited trading strategy, but as of now there is no max 2% risk rule at Lark Funding. Another rule we are seeing implemented across several firms is a minimum trade time. More specifically, some firms are implementing a minimum 2 minutes per trade. This means that you can't open and exit a trade within less than 2 minutes. You need to hold a trade for a minimum of 2 minutes in order for it to be considered valid. Now, from what I have seen, most firms, this is considered a soft breach if you breach it, meaning you won't lose your account completely. And I do think that for 99.9% of traders, this is not going to be a problem whatsoever. Now, for some very high frequency trading scalpers, this could be a problem. But this brings us up to the question of why is this rule being implemented? And personally, I believe it is because firms are trying to limit and fully remove nefarious trading activity that's taking place on their platforms. More specifically, everybody knows about HFT bots, high frequency trading bots, where you will try and take advantage of a demo feed latencies. So you'll have a bot, you'll get in and out within the same second and profit. Now, of course, any firm that is even remotely legitimate won't allow these kinds of EAs. If a firm does run far away from them. And so I do think personally that this rule is to just try and further limit that kind of trading activity. And again, for some scalpers, it might be a bit of an issue, but if you're getting in and out within less than 2 minutes, we don't see a ton of that out of Lark Funding, so I don't think that this rule is going to raise any major red flag. Before we move on to the third change that we are seeing in the industry, which is actually the most major change that we're seeing, I'd like to quickly mention Lark Digest. We are currently building the #1 newsletter, email newsletter for traders that are trying to get funded. We are sending emails out every Monday, Wednesday, and Friday. We're sharing insider data from prop firms. We're sharing news on the prop firm industry so you can keep up to date with everything that's going on, all kinds of Twitter drama, all that good stuff, and anything that you need to know that we think will help you in regards to what's happening in the market that traders need to know. It's entertaining. We try and make complicated subjects very easy to understand, so you can subscribe down below. We have hit 20,000 subscribers on that list, so it is growing very, very quickly. Okay, time for the third change that we are seeing across the industry, which is by far the most major as of right now, and that is news restrictions. We are seeing a ton of firms across the board implement different types of restrictions on trading news. Some are simple, some are difficult to understand and follow along. Some are saying that if you have a trade before the news and you carry it through, it's fine, but if you hit your take profit, it doesn't count, but if it hits your stop loss, that loss is a valid loss. It's very complicated, so whatever firm that you're considering, hopefully Lark Funding, we have 0 news restrictions. You can trade the news, you cannot trade the news. 0 news restrictions as of this recording at Lark Funding. But if there's another firm that you're looking for because you want to diversify, smart move, you're going to want to look very specifically into this. Now, why is this happening? Why are firms limiting this type of trading activity? I think there's a few reasons. One, there's a lot of traders, as always, that gamble major news events such as CPI releases, that sort of thing, interest rate decisions, and there's huge spikes in the market. Now, would this actually happen if you were trading a live account? Personally, I don't think so. If you're a professional trader, there's no way that you're going to risk 5% of your account balance on an unexpected, unpredictable data release. But hopefully, firms are being very forthcoming and very clear in how they are listing this, because it's possible that firms could implement this rule to try and deny certain payouts. But that is something that we're seeing across the board, and there are a ton of firms that have been implementing this. So moving forward overall, what does this mean for the industry? For some traders, some of these new rules are going to be painful, but overall, I think that this is fantastic for the industry. We saw the funded trader cease or temporarily cease operations, and we can see that they had very generous rules, 200 to 1 leverage on some of their accounts. It was fantastic for traders, but unfortunately, it looks like for whatever reason, those rules may not have been sustainable. Again, I'm not speaking specifically on them. I have absolutely no way of knowing what went on, what's going on. But I think overall there is a shift in the industry taking place to rules that are more sustainable, and I think that is fantastic. It brings us up to the previous point that I brought of firms needing to think long-term. We're really ultimately trying to filter out the gamblers from the traders that know what they're doing and the traders that don't. That is the only purpose of an evaluation. That's it. If a trader can pass an evaluation with sufficiently strict and difficult rules, it shows that they know what they're doing, and therefore a firm will be more easily able to use their data. I've been saying this from the very beginning since we launched Lark Funding. We are not the easiest evaluation program out there, nor are we the cheapest. We have some rules that traders have complained about, and that's totally fine. There's a reason that we launched the way we have. There's a reason that we are roughly 700 days without denying a single payout. June 1st, 2024 will be our 2-year anniversary without denying a single payout. That's because we have sustainable rules. So as a trader, you need to adapt to these times. It's easy to sign up for a challenge that has easier rules, higher leverage, benefits that seem nice as a trader, but you have to ask yourself, are you going to receive your payout? If you go for these new firms that are very flashy, it might be tempting, but again, that is short-term thinking, kind of instant gratification vibes. That's not what we're going for. We're thinking long-term as the only way that things, both for a firm and the industry as a whole, and as a trader, things are going to work out. If you made it this far, we appreciate it. We'll see you in the next one. Please subscribe to Lark Digest down below. Appreciate it. Thanks for watching.